Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is threatening Iranian energy sites if the Strait of Hormuz is not reopened soon. In a post on social media, Trump said the U.S. would respond by blowing up and obliterating Iran's power plants, oil wells, and Karg Island if the strait remains closed. The remarks come after a brief pause in attacks on energy infrastructure as the two countries held talks aimed at easing tensions. We are watching shares of Air Canada today after news that the Chief Executive Officer, Michael Russo, will retire by the end of September. The move follows backlash from his release of a condolence video for victims of the LaGuardia airport crash in which he did not speak French. The airline says the search for a new CEO is underway and that the ability to communicate in French will be considered in the decision. Aluminum stocks are seeing gains after a jump in the price following Iran's attacks on major Middle Eastern facilities. You can see Alcoa is up more than 10%, Century Aluminum by 8.75%, and Rio Tinto by about 3.3%. Now, the attacks are raising concerns that the already fragile market will plummet into a crisis and push aluminum prices to record highs. Some experts believe the strikes raise the risk that the impact on global production may persist long after the Strait of Hormuz is reopened, potentially forcing factories into temporary shutdowns. And looking at the markets, you can see the TSX continuing its rally from Friday. Actually, last week it ended up slightly. We're still down for the month of March noticeably, but today it's up by 1.3%. South of the border, hopes of an off-ramp for the war in Iran spurring increases. People looking for some deals out there as well. The S&P 500 up by more than a half, the Dow by 0.88, and the Nasdaq by 0.31. Okay, the S&P 500 is up slightly this morning after the benchmark slumped to an August low at the end of last week. U.S. President Donald Trump saying the U.S. is in talks with a new and more reasonable regime in Iran. Looking at historical trends and the data, our next guest says that the second year of the presidential cycle tends to be the weakest year for the markets. Joining us now, Sid Mokhtari, Chief Market Technician at CIBC Capital Markets. Sid, thanks as always for joining us.
Thanks for having me, Roger.
All right, let's talk about that part there, about year two in the presidential cycle, which we're into now, being the weakest one. What points to that?
Sure thing. Roger, when we came into the year, we kind of made the case that we may be faced with two colliding cycles, one being what you suggested, being year two of the U.S. presidential cycle, which has very poor hit rates by historical measures. We're looking at about 52% hit rate. Average returns are about 1 to 2%. So it's not the best set of results when we look at it historically. We also looked at year four of a bull cycle. In other words, 2022 was the low of the this market from a cycle perspective. In hindsight, 4 years later into 26. We put them together and we looked at average returns, price patterns of history. We kind of made the case that, first half historically is the weakest part of the year. Second half is better than first half, and Q4 is historically much better in, year four of a bull cycle. So I still think we have some challenges to deal with, albeit market appearing oversold by some measure, but it's best to be, treading carefully out there.
Yeah, it sounds like we could almost see them kind of those concepts butting heads a little bit this year.
I think that's a very reasonable argument. We had three successive high double-digit returns for the S&P 500, as well as Canada. We've had a lot of good returns, globally speaking. So this market is mean reverting, call it negatively by some measure. given some of the gains back. But we think this is still, by definition, a longer-term secular bull market, and this is a mean reversion or a reset cycle year that should be able to give us buy opportunity. I don't think we're there yet, but by some measure, near term, there are some oversold bounces that may develop. There are pockets in the market that are tied to late cycle narrative or patterns that we have talked in the past together. Energy, obvious, at the risk of stating the obvious, is the right pocket. We're seeing MLPs, renewables, parts of utilities. They're all acting quite well. There is money flow, there is alpha, there's strong momentum and trends associated with those sectors. So, like I said, there are pockets that investors should tactically be engaged in, and they're tied to, call it, commodity cycles and late cycles, if you will.
And are there sectors that lag or dip more than others?
Yes, we've already seen consumer discretionary as well as financials in the U.S. falling, notably into our weakest, quad ranking. In Canada, we're also seeing financials, slipping in ranking, if you will. And if we think we're correct in our estimation, this is a late cycle playbook. Both discretionary and financials should remain in a, call it, penalty box from a rate of change of alpha or absolute perspective, and other parts of the market should do better that are tied to the late cycle, being commodity areas as well as energy and utilities. I mean, we're seeing telcos coming up very nicely in our matrix processes. Our quant factors are also showing low vols and dividend yield, and parts value quality coming up in our rankings. So I would say we just have to be a lot more systematic and a lot more active this year, to be fair with you.
Okay, and of course, I mean, throwing in all this, we've got the oil shock. How does this compare to past oil shocks?
When we looked at all historical oil shocks, and we found that corrections are rather drawn out. They're elongated. So we do think this correction that we're seeing in the market, we started talking about detrending phase of the market. We are still in the progress of that detrending phase. We see more downside for S&P 500. TSX hasn't really resolved its what's called an outside month or a bearish engulfing pattern that it has had in the past month. So backup attempts are likely to have some challenges, and then we'll estimate lower levels to be validated. We think TSX potentially closer to 30,000 and under. We can revalidate some of our views. For the SPX, we're looking at 6,000 potentially on the downside. And like I said, we just think we have to be playing this market, if you will, from a more relative strength or relative gains, if you will, as opposed to wanting to being too aggressive in absolute gains. But taking you back to your question, these oil shocks of the past, if there were a roadmap, they are giving us some indications that this correction does have more time behind it.
And what might change that time? If you think when we could drop down to 30 on the TSX, what might change that?
Well, I mean, if we get a sharp recovery within financials as well as consumer stocks, along with industrials that have been somewhat lagging with given parts tied to curve steepening peak that we saw in the U.S. Same with Canada. If we get the flattening and inversion in that pattern, it is not necessarily going to be a boring condition for financials. So if that changes, which we don't think that would be the case, then we should be able to see some recovery. But everything we put together, they're all showing us that we need to be expecting more, call it, challenges, or call it, no gain, no pain, no gain narrative. We need to do a little bit more work here before we can reset a lot of indicators, a lot of breadth factors, before we can show recovery. But like I said, anything's possible. We just don't have the data for it right now.
Okay, we have to wrap it up there, Sid, but thanks as always for joining us.
Thanks, Roger.
Sid Mokhtari is Chief Market Technician at CIBC Capital Markets. Up next, an update on the oil markets by the principal of the Short Report, Stephen Short. more about the oil markets. We were joined earlier by Stephen Schork, principal of the Schork Report.
I think anyone who came into this and saw what has transpired over the last 4 weeks, if you were to think, oh, this is going to be a short-lived war, Andrew, they're not living in the same world that you and I are. This is a much different operation, and I think the administration has done a horrible job of communicating expectations on how long this was going to take. Therefore, and why I'm going there, and I went a little bit political there, is because as an oil trader, oil analyst, you are living off of every tweet, every headline that is coming out of the market. So we saw a lot of volatility in those first 3 weeks. Last 4 weeks, the fourth week, last week, we did pull back. Now, NYMEX WTI, commodity markets like to mean regress. So when we just modeled out the path for the next 4 weeks for the current prompt market for May delivery, we're looking at a median price of potential outcomes of about $93 a barrel. Our first standard deviation envelope, the ceiling, is $102 a barrel. So we got up to over 103 in overnight trading. We're back below, I believe, 102 right now. So we're right there. So as a quant, as a trader, what this is telling me is the market is settled in to a reasonable trading range, and we're just now waiting for that next catalyst that could send us significantly higher, because once we go beyond $102 a barrel, a sustained trading pattern above that, then the potential of the next level is significantly higher above there.
It's interesting, yeah, there's speculation that U.S. troops might go in physically to snatch Iran. Well, the Wall Street Journal says President Trump is weighing snatching the uranium. But people will remember, old guys like you and me will remember 1980, so-called Operation Eagle Claw, and they tried to put in choppers under President Jimmy Carter to rescue the hostages, but that operation ended in failure.
Yes, I mean, and that's fair, and yes, I do remember that very well, but this is not the same military it was under Jimmy Carter's 1979 presidency. I mean, we're looking at a military that pulled off Osama bin Laden, pulled off the Maduro execution. We're talking about a military that is at the peak of its game. I'm not advocating, please don't take this as I'm advocating boots on the ground and we're going after this, but we've seen how the U.S. military has responded going back to, what's the last roadmap we had for this? The first roadmap, that was 1990 when Iraq invaded Kuwait. So the big difference between then and now is in 1991, when the war began, we had a clear roadmap. That roadmap was simply get Iraq out of Kuwait. Once that occurred, the war was ended, and that's how the market reacted. And the market sold off extremely fast as soon as that war began. So now we have a situation where what is the roadmap? Is the roadmap ending Iran's nuclear capability? Is the roadmap regime change? We simply don't know. That is, when I say we, the market simply doesn't know what that roadmap is. So we're still trading on a significant amount of volatility. And what we have, Andy, is a bifurcated market. We're talking about oil at $100 a barrel. Well, last month, oil, where it counts, was $170 a barrel, and that is in the Asian markets. And those are the markets most vulnerable to the bottleneck that we're seeing. Those are the markets that are short oil, and those Asian refiners are bidding for oil at significant premiums to what you and I comment on, the NYMEX WTI contract or the ICE Brent contract. So what has transpired now, Andy, over the past week is we're starting to see that panic now spread out. So I can put oil delivered into Houston out of my West Texas production. I can put it into Houston and sell it on the global market and still net an $8 profit. So what we're going to start to see now, Andy, over the next couple of weeks is a significant bid that U.S. oil in the Gulf Coast is the cheapest barrel in the world. So there's a massive arb, whether you're a European refinery in Rotterdam or you're an Asian refinery in South Korea. You are bidding for these Gulf Coast barrels. So at this point, that is the market we really want to watch for, is the spread differential between Gulf Coast barrels, i.e. NYMEX WTI, which is trading right around $102 a barrel, and the foreign price of oil. So I suspect in the weeks ahead, U.S. oil prices, when we say $102, that is cheap relative to the rest of the world. I would suspect that price to increase to catch up with the world. So what I'm saying, Andy, is we're looking at oil. If we do not see any sort of resolution, and by resolution I mean a resumption to flows of oil through the Strait of Hormuz. I'm not a military guy. We just see more oil hit the Asian markets. Without that, we're looking at oil prices higher for much longer.
It's interesting, yeah, you refer to the disconnect between the paper market, the so-called paper market, the futures, and what's happening in the real world. And RBC saying, oil executives say this is not sustainable, this gap.
Yeah, absolutely. So what we're looking at right now, and that's what happens, nature abhors a vacuum, traders abhor an arbitrage. So that arbitrage, which, as I said, for barrel West Texas oil delivered into Houston at about $7 to $8 premium above the global price, you're going to see that ARB close. So what does that mean? You're only going to close that ARB two ways, Andy. Demand destruction. So take that demand out. And by demand destruction, of course, we're talking about significant economic contraction, i.e. recession. Or you're going to see that supply, that price rise to meet the market. I'm going, at this point, the price will rise to meet the market. So at $102 a barrel, which is where we've mapped out for the next 4 weeks, our next tranche, our next ceiling is now for WTI, $133 a barrel. And that would put it more akin to where the Asian markets and the seaborne markets are trading at this point. So certainly I expect that vacuum to suck prices higher. That gets us to $133 a barrel over the next 4 weeks. Again, assuming we don't see any sort of resolution to the current conflict.
Sorry, give us that number again before I let you go.
133 NYMEX WTI over the next 4 weeks if we do not see any sort of resolution to the conflict right now.
That was Stephen Schork, principal of the Schork Report. Coming up, today's market drivers with Bloomberg's Monique Molima. We'll see why Sysco's new deal is weighing on the shares. Time to take a look at the market movers for today. We're joined now by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us. Sysco in the middle of a big deal, but investors not liking it.
Hi, yes. So Sysco announced today that they are acquiring Jetro, a food wholesaler, for about $29 billion. And their shares have been falling on this news. While the analysts say that Jetro does have strong earnings multiples and good cash flow, there are concerns about how much Sysco is paying to acquire this company. $29 billion is about 14 times Jetro's net income, and analysts say that this is pretty high for peers in the sector. So they just have some concerns that this might increase Sysco's debt leverage and that they've potentially might have overpaid for it.
All right, we've got a lot to get through today. Canadian energy stocks. I was looking, actually, the TSX was actually up last week, and I think the energy stocks driving a lot of it.
Yes, so the Canadian energy stocks are higher today. They've been rising on the higher oil prices we've seen related to the Middle East war. And analysts at Raymond James actually upgraded a number of these stocks today, such as Athabasca Oil. They note that with U.S. energy prices being really high and the Canadian dollar being lower, it actually makes Canadian energy more attractive right now for investors elsewhere that are looking to buy energy, particularly with there being a tighter supply out of the Middle East. So they see these companies being able to benefit from that. And they also think that with some of the concerns around energy security right now, that maybe that will also increase support for a pipeline out west in Canada. So they see a lot of tailwinds for these companies going forward, but they do note that they have seen quite a bit of gains. Canadian Natural Resources is one in particular they point out that maybe has kind of already seen as much gains as is merited because they have a little less exposure to the spot prices of oil.
All right, Sigma Lithium has some new deals, and that's good news for them.
Yes, definitely. Very good news for them. Their stock rose the most since 2020. So they saw over 40% gains earlier today off of this news that the company projects that they can triple their cash flow coming in on a quarterly basis with the new lithium offtake agreements that they have in place. And this is really something that investors had been looking for new agreements, particularly because the company had temporarily halted production at its Seoul mine last year. And that raised some concerns about liquidity for the firm. But now with it being back in production and with them actually looking to expand production and with these new agreements, it's giving investors a lot more confidence in the company and its stock.
Okay, and we're going to sneak in Archer Daniels Midland, getting some benefits from the new U.S. Environmental Protection Agency. You finish the rest. There's a lot of words in there.
Yes. So the U.S. Environmental Protection Agency at the end of last week announced new rules for biofuels in the U.S. And Archer Daniels Midland is expected to benefit from these rules. The rules in place are going to have higher requirements for biomass diesel. And also the EPA issues company credits for the production of these. And they lowered the amount of credits that they're planning to issue. So these combined factors, analysts say, is actually going to cause a tighter supply of biofuels. Which is going to also lead then to higher prices. And Archer Daniels Midland, as a company that has these credits that can meet these requirements, is expected to benefit and see higher earnings as a result.
Okay, we have to wrap it up there, but Monique, thank you as always. Bloomberg's Monique Malima. Up next, the energy supply shock shaking global markets has some North American companies positioned to benefit. We'll break that down after this. Bloomberg News is reporting the federal government is working with Quebec to prevent the closure of Canada's only copper smelter after Glencore threatened to shut it over new pollution control requirements. Last month, the company suspended plans to invest nearly $1 billion into its Quebec operations after talks on reducing arsenic emissions collapsed. Quebec is now proposing legislative changes to address some of Glencore's concerns. We are watching shares of Eldorado Gold and Foran Mining. Fairfax Financial is backing a proposed deal between the two companies. Fairfax has agreed to vote all of its Foran shares in favor of the acquisition. It owns more than 120 million shares, about a 22% stake. The deal is worth nearly $4 billion and will target production of about 900,000 gold ounces in 2027. Shares of Sysco are really taking a hit. That after the food distributor agreed to buy the privately held Jetro restaurant depot for $29.1 billion, including debt. Sysco is pausing its share buyback program. In the meantime, Sysco supplies food to restaurants, hospitals, and schools across the U.S., and the deal would create one of the largest food service groups in America. The stock's down more than 12%. And taking a look at the markets, little rally continues for TSX from Friday. It's up more than a point right now, and about 32,300 south of the border. Everybody's in the green. The Nasdaq, you can see, is just kind of holding on, pretty much a wash. But the S&P 500 up by 0.3, and the Dow by 0.7. Strikes on Qatar's LNG hub has sent shockwaves through global energy markets, with U.S. natural gas producers poised to benefit. To help break down what this means for prices and supplies, we're joined now by Thomas George, President and Portfolio Manager at Grizzle Investment Management. Thomas, thanks very much for joining us.
A pleasure to join you.
All right. You're calling North America the world's energy backstop. What do you mean by that? And is that just a temporary title that they may hand over again?
No, I think this is structural, and this is a functional change, and something we have been structurally very bullish on the energy complex as it relates to disruption, specifically all of the technological disruption in the economy. We've been very unique in that stance. We've seen that the value of these commodities have really come through, but I think what this current situation in Iran has really highlighted is that diversification, security of supply continues to be such an important component of the global energy mix. And I think that North America specifically is going to be viewed in a very different light as a core backbone to the energy infrastructure in a world that is energy starved, really, as it relates to the AI revolution.
What will be a real turning point for you in that to make you say, yeah, this for sure is going through?
Yeah, so I think all of what has happened in the last month is the turning point, right? So if you are a buyer of energy, specifically LNG, you are looking at a moment where basically you've had your supply cut off. And now if you're going to look out 5 years, 10 years, are you really going to go back to and I'm talking emerging markets, Europe, are you really going to go back to that same distribution mix coming from Qatar, maybe predominantly, maybe 50%, or are you going to now distribute that across North America, Australia? I think that component is just going to be a very different view. And I think the assets around that, the LNG assets around that, we still think do not get the valuation bump that they deserve when you're looking out long term. Can they handle it, and if they can, is there enough time to kind of get up to speed? Yeah, so I think in the current, all that's happening currently, obviously, we're in a pinch point right now. If we see through to a normalization, which that could take a year, we think that as everything realigns over the next 3 to 5 years, that is when you start to see the growth the pointing to the growth in the North American complex. And I think that definitively we can definitely backstop into that. Are there going to be pinch points? Of course, but I think that any price signals just underscores the value of getting more volume out of North America. And what kind of a role do AI data centers, the build out with LNG? Yeah, so I think AI data centers are obviously an important component of the demand growth mix. Clearly, that this has sent a shock into the system in terms of how almost the timing couldn't have been more challenging for the global economy in terms of just the demand wedge that AI is driving. Now, of course, AI is going to look for a diversified feedstock with respect to energy, but LNG, without a doubt, is going to be an important component. And so I think AI is going to continue to think about, and if you think about all of AI's incremental energy demand out of North America particularly, that's all come through gas, right? That has been the fastest way to deploy energy. Now, we think the next step is obviously going to be nuclear, but again, all of this still will be functionally feeding the AI growth cycle. Okay, and you've got some stocks. Want to get to them. Comstock Resources. Yeah, so Comstock Resources. So our view is that you play this through the entire value chain. So we think you own the LNG exporters. So for us, that's Venture Global, Cheniere. The Venture Global's our largest holding there. So I think that's a straightforward play that you'll get a real tailwind there. And then you own the basin plays as well. So Comstock for us, it makes a ton of sense. Low cost, dollar, their costs are $1 per MMBTU, markets at $3. You functionally have to believe in the long-term view that $3 is going to converge. It may not converge completely, but it's got to be higher than where Asian and European prices are currently for natural gas. So it really is a margin expansion play there. And in Asia and Europe are trading at $20 per MMBTU in and around. So, I think that for us just makes a ton of sense. And for us, Comstock fits well there. Okay, Antero Resources. Yeah, so Antero, again, very similar. For us, Comstock feeds right into the, their basins feed right into the LNG terminals. But for us, Antero, is Marcellus and Range Resources fits in that as well. Now, their prices are higher, their costs are higher at $2. But again, it for us, these are high quality names. Now they have more liquid, so they do gain with the oil price as well. But again, for us, it's a combination where if Comstock's giving you that dry gas, what you get with Range and Antero is you get a mix and also a very advantaged price profile as well.
All right, we got to wrap it up there, Thomas, but thanks very much for joining us.
A pleasure. Thank you.
Thomas George is president and portfolio manager at Grizzle Investment Management. Coming up, Air Canada's CEO will retire in the fall amid a slew of controversies. We'll have more after the break. Air Canada CEO Michael Rousseau will retire in the fall after nearly 2 decades with the airline. This comes amid the aftermath of the fatal Air Canada plane crash that claimed the lives of the 2 pilots at the helm. Joining us to discuss it is John Gredick, a faculty lecturer in aviation management at McGill University. John, thanks as always for joining us.
Pleasure, Roger.
Was this the Air Canada said they had been succession planning? Was the succession planning sped up a little bit, or was this something that really was in the works?
I was. I think that, you talk about the responsibilities of the board of directors and their subcommittees of the board, as we know, and the HR committee has a responsibility to, in fact, maintain its succession planning practices in place. So there are the top 5 or 6 jobs in the company that are constantly being reviewed by the board and the subcommittee dealing with succession planning. So it is a normal process within the business. I think what's happened over the last, I'd say, a couple of weeks, and in the last 72 hours, probably more so than anything else, is speeding up the process rather than being really just planning. Mm-hmm. We're now moving down to execution and the actual realization of that succession plan for the role of the CEO. So it's now changed its velocity and pressure on results. So it is going to be a board-led process, and they've already made some indications as to what some of their key selection criteria will be.
One of them being French. I mean, how important is that to a CEO to be able to speak another language, or at this, and at Air Canada, which is a bilingual company? How important is it that they be bilingual?
Well, we've had, a number of CEOs at Air Canada in its recent history since it became privatized, since it left the Crown Corporation. If you remember, a few years ago when Air Canada was in CCAA, we had 3 U.S. presidents in a row. We had these individuals were brought in from the U.S. to pick up the reins at Air Canada, and none of the 3 were French-speaking. And there was no noise, no brouhaha. Everybody was focused on getting Air Canada to survive CCAA. So now, 40 years later, we're now in a different mindset. We now have a different society that we live in Canada. We now have a much greater focus on not only financial performance as we see today, but also now on language and the ability to communicate in both official languages at the executive level. So I think that that's where we've changed as an entity, as a corporation. Society has changed. Canadians got different characteristics of what they would like to see come out of a CEO of a bilingual company, and one of those is now speaking very effective.
All right, and I want to talk a little bit about the crash itself. There's been a lot of concern about air traffic controllers in the U.S. that maybe they're short. What's the situation like here in Canada? Because I believe on the night they only had the 1 air traffic controller, which is fairly a normal situation, but is it a healthy situation?
Yeah, air traffic control is very sensitive in terms of the type of jobs that they do and the number of people that we put in those roles of responsibility. The U.S. has made it very clear that they're short 3,000 controllers. I made a statement last week that I thought Canadian shortages were around 1,500, and of course I was totally mistaken. I've used old data and old numbers, and NavCan came back and confirmed we're 200 short of a total establishment of 1,900. So we are short in Canada controllers. We have to do some work to kind of close that gap. That shortage is in fact showing up in terms of delays that Canadians are going to be expected to incur as a result of those shortages. We will have ground stops. We'll have significant issues with some of our major airports in handling the summer volumes coming up. So we have to close that gap. NAVCAN is closing it slowly but surely. They've got 500, 600 people in class at this point. But it's going to take 2.5 years to get these people out of class and onto a job where they can handle the work that they have to handle. So we're still about 2.5 years away from fixing that.
And I imagine with burnout, I mean, that's one of the most, isn't it considered one of the most highly stressful jobs on the planet?
Yeah, it's a job that I can't do that job. I have no intention of even considering, even though the money's good. They were talking about salaries in the 150 range, controllers, but just the job itself and the stress level and the fact that you've got to be paying attention second by second, directing airplanes that are containing thousands of passengers, and it's your job to basically make sure that those planes are operating normally. It's an important part.
And now you mentioned it's going to take a couple of years to catch up. Is there a chance that they may continue to play catch up as we lose more people to burnout and retirement?
Yeah, we're going to lose more. I think it's going to be a question of making sure that we've got the right number of people in a job, and we're managing those shifts, and we don't overload the controllers that are left on the job. And I think that's something that has to be done.
And sorry, you cut out there at the end. Yeah, you'll see that that's something that has to happen is the catch up.
Busy morning, Roger. What can I say? Have a good day.
Okay, John. Thank you for
Crazy.
Oh, John, we had a little of a cut off there. Okay, that was John Graddick, a faculty lecturer in aviation management at McGill University. Coming up, Canada continues to push for an increase in defense spending, this time awarding 3 long-term support contracts worth about $1.5 billion. We'll have more on that story after the break.
I'm Adrian Gobriel tonight on CTV National News. The growing crisis of online misinformation threatening Canadian sovereignty.
It's a fundamental challenge to our shared understanding of reality.
The surprising country that's now a major source of the false and divisive content. Tonight on CTV National News and ctvnews.ca.
Well, Canada is boosting its military capabilities with $1.5 billion in long-term defense contracts awarded to L3H Harris and Airbus. Ottawa says the deals will support hundreds of jobs across the country and strengthen the reliability of its air operations. For more on this story, let's bring in Laura Dillon-Kane, Ottawa Bureau Chief at Bloomberg News. Laura, thanks as always for joining us.
Thanks for having me.
Okay, so what are some of the details on this? Where's this money going? It's a nice chunk of change.
That's right. It's $1.5 billion for 3 contracts. 2 of them are going to L3 Harris. 1 is going to Airbus. It's about supporting the new CC-330 Husky fleet. This is a fleet of 9 Airbus jets, 4 new, 5 used and converted, that Canada is acquiring. And they're replacing these aging Polaris aircraft. And the goal of this fleet is to do air-to-air refueling, to do passenger transport, medical evacuations, and strategic missions. So these contracts are about supporting that new fleet. The new fleet, the first delivery is expected in 2027. So these support contracts are long-term contracts, about 10 years at least. And L3 Harris is going to do maintenance on the planes, while Airbus is going to, of course, these are their jets, these are Airbus jets, they're going to do engineering and airworthiness support. And the government says they could support up to 720 jobs in Ontario, Quebec, and Alberta.
I was going to say an American and European companies, so we are going to see some benefits, but not a lot, though, by the sounds of it.
Well, up to 720 jobs is nothing to sneeze at. And, Canada is pushing where possible to see as much domestic investment into the country from this renewed push toward defense spending. So last week, the Prime Minister announced that Canada had met its 2% of GDP target for the NATO alliance. It has never met this target since agreeing to it in 2006. It actually hasn't spent this much on defense since before the fall of the Berlin Wall. So there is a huge renewed push toward defense spending as the US pulls back from the NATO alliance. And we've also released a defense industrial strategy that aims to spend more of that money in Canada where possible, and then where not possible, it aims to at least get some kind of domestic benefit. So even if we have to partner with a European or an American company, what parts of the defense product can be built in Canada? Where can we create jobs? So that's really sort of the singular focus of, okay, we do have to increase our defense spending in order to be able to defend ourselves as the US pulls back from these arrangements, but how can we also use that to catalyze new investments in our economy?
And are we expecting any more announcements like that in the next little while, or is this kind of the one and done for now?
It's going to be kind of a near constant rollout of announcements, to be honest with you. We have now met the 2% target, but that target's already old news. We've agreed to a 5% target by 2035. That means we have to move a lot of money pretty quickly. And though that is broken down into 3.5% on core defense and 1.5% on related infrastructure, so allowing for a wider array of spending, we still have to spend a lot of money in order to hit that goal. We have a large economy, so 5% of it is a lot. So we are expecting many more announcements to come, almost on a near daily basis. So definitely stay tuned for more defense spending. And the government's also facing some more calls for more transparency about how it's spending this money.
Okay.
So expect to see them, hopefully making more public announcements about how they're doling out this cash.
All right, we'll wrap it up there. Laura, thanks as always for joining us. Laura Dillon-Kane, Ottawa Bureau Chief at Bloomberg News. Over the last decade, malls were left for dead, casualties of e-commerce and shifting consumer habits, with the pandemic seemingly sealing their fate. Gen Z, though, however, is bringing malls back, reviving them as social hubs and retail meccas. Bloomberg Originals has more.
For some generations, malls were the epitome of American capitalism and socializing at its finest. But the outlook for these retail meccas in recent years has looked a lot more bleak. Pre-COVID, people were starting to talk about the death of malls, and then obviously in COVID, no one was going to malls. But since restrictions have lifted, teens have really helped bring back excitement around the mall.
It's just fun. Like, we make a day of it, we shop, we eat. It's just not about just the shopping part, it's about the experience.
We visited a mall outside of Philadelphia called the Camp Prussia Mall, and it was packed on a weekend day.
Look at it. This is so pretty.
Trying on stuff. And just the more excitement. Just walking around, looking at everything in the stores.
That's cute. The appeal part is wandering.
Princess Polly.
By the time you look up, we done visited and shopped in like 10 different stores.
Pre-COVID, e-commerce really picked up. People were able to go online and buy what they need instead of having to schlep to the mall. But post-COVID, shoppers do want to go into stores. They want to touch and feel products. They're sick of buying things online.
Mom, what? This is cute.
And so I think some of the online brands, especially ones that cater to teens, are seeing a lot of value in having a real retail footprint. Looking at indoor malls specifically, foot traffic took a nosedive during the height of the pandemic, as you might imagine. But it's since rebounded and at times even outperformed pre-pandemic numbers. For a lot of this teenage generation's formative years, they were stuck at home, they were communicating via Zoom, they were going to school on Zoom, they were using social media to chat with each other. And so I think now that we've returned to a level of normalcy, teens are very excited about going back outside and kind of doing a lot of the nostalgic activities that we all remember from our childhood, and going to the mall is one of those. Brands are conceptualizing their store based on having things be like TikTokable or Instagrammable. So stores are starting to have photo booths or in-store experiences. They're making their dressing rooms bigger. Brands like Addicted, Princess Polly, brands that show up on TikTok and social media are catering to like teens and young shoppers. And then some more classic teen brands that are making a comeback. Hollister is really hot with teens right now. Garage is another one that's having a big resurgence. Malls now have amusement parks. They have indoor skiing, experiences to bring people in for the whole day rather than just having shoppers pop into one store and then leave.
Let me see how much all this costs.
Part of the mall experience is that parents, for most teens, are funding their shopping.
I like this one. Yeah, it's 30% off.
Either kids are bringing their parents, they have like a credit card or money from their parents. Kids are driving the shopping, but parents are the ones who are ultimately funding this endeavor. Higher rated malls are doing better. I think those are the malls that we've really seen be able to bring in this wider array of stores. So not just having the more classic mall retailers, but expanding, having art exhibitions, having outdoor space, having amazing restaurants. And I think for younger generations, it also shows this excitement to be in person, to, bring what they're seeing on TikTok and social media to like what they're doing in their day to day, and also to build community around it.
Especially for like COVID, when everybody was shopping online, I feel like the malls, I see a lot of people in the malls nowadays.
Market Call is coming up next, and today on the show we have Dan Rohinton. He is the Vice President and Portfolio Manager, and we'll be taking your questions on Canadian and global large caps. Of course, he's with IA Global Asset Management. Let's take a quick look at the markets, see how they are doing. You can see the TSX having a nice rally right now, up nearly 1.25%. S&P 500 also in the green, same for the NASDAQ for today. And that is it for us for Morning Markets. Thanks very much for watching. See you back here tomorrow.